This is Justin Pulitzer. This is my weekend review video for Sunday, March 20th, 2016. A good amount to cover. We had some Fed info this week. I'm going to start off with discussing that briefly, then we're going to get into the 6 market keys and now officially the 7 Fed keys. So the Fed basically came out, and I believe that their statement should have been construed as dovish. They talked about a lot of fear. Global risk really came back into play. They talked about inflation-adjusted incomes, that they're improving but not fast enough. They want to really be sure that the labor market is really getting better sustainably. They talked about the neutral Fed funds rate being historically low. That's really going to be code now for lower for longer, so keep an eye out for that neutral Fed funds rate talk. And that was basically it. There was some more other nuanced stuff. If you want to hear that, I suggest listening to my Periscope from this past week. I cover the Fed in quite a lot of detail. I don't want to be too redundant here. This is really the big story, though. On the CME website, you could take a look. They show you the percentage probability of a Fed rate hike. And going into this meeting, you can see April is basically 7%. But going into this meeting, this June number I saw anywhere in the high 40s to low 50s. And after the Fed statement, this completely dropped like a rock up to well below 50% and basically closed on the lows for the week. And you'll be able to see July, obviously, it starts ticking up a bit, but still below. And I think the September meeting now is really the first live one. You could see that's got 60% going forward. So the potential for the Fed, they had talked about having possibly 4 rate hikes this year, has now been pushed out to 2, and they brought down their expectations for rate hikes for the basically by half a point going out for the next few years, saying that they don't see to reach their inflation target until 2 to 3 years from now, which is quite a stunning admission to me, because if they don't see inflation and they don't see growth, there's really no reason to be hiking interest rates. And they basically discussed this. So this is really why the market, I believe, has been bullish, the anticipation that the Fed was going to kind of push out and be lower for longer with regard to the interest rates and when the next hike might come. So you can see it's less likely than not that it won't happen before September, and then September potentially comes into play. I think that was smart of the Fed, wanting to see some more data, get to see the first quarter results and also the first quarter revisions and the second quarter, and really make sure that the economy isn't in danger of slipping into recession before the hike. I think the Fed basically has acknowledged that the hike that they did last year was a mistake, and they couldn't have done it at a worse time. It was really right into the teeth of when growth has been slowing. Since we started out with the Fed, I think I'm going to just jump into the 7 Fed keys right now. And since it's a logical segue, and then we'll tackle the market. The non-farm payroll numbers have been not that great. I know a lot of people are saying that they're, okay. The headline number is only 4.9%. But the truth is when you look at people who have part-time jobs or are being underpaid for the jobs they're in, or have been unemployed for so long that they no longer count, that number's significantly higher. The Fed also talks about their GDP numbers. Those forecasts have been rather weak. They bop around a bit, but they're all basically still at or below 2%, which is a rather weak economy, which is vulnerable to shocks. We've discussed in the last couple of weeks, I discussed the ISMs and the PMIs, both the servicing and the manufacturing for the ISM. And I talked about how the absolute number is terrible, but the rate of change, meaning the speed at which it's going down, has been slowing. So that means the economy is sort of leveling off a bit, but it's still not good. It's still it hasn't stopped the decline. It's just sort of slowed a bit, which is, a good sign. The durable goods order numbers I had talked about were a little bit better. We all know that autos did well. Planes, I've talked about the slowing there with Boeing. Housing, we know that number has probably pulled forward a lot of demand because of the seasonably good weather. This is like the warmest winter in quite some time. I'll tell you, in the area where I live, there's a lot of new development, and construction that should have halted during the winter months basically went on throughout with no halts in the constructions, maybe, save a day or two for a little snow or what have you. But A lot of these projects are well ahead of schedule, so it's good now, but it could be a problem going down the road because it pulled demand forward. And, some of the metrics of less talked about durable goods, like dishwashers, washing machines, toasters. Finally, after 10 months of people basically twiddling their thumbs, they finally bought a few of these things. I mean, we're not going to be a toaster-powered economy, I assure you. And waiters, waitresses, and bartenders, and carnival ride operators. I joke about the carnival ride operators, but that really was a thing this past summer. They're not going to really power the economy forward. And I don't want to get too into it here. If you're curious about this, I discuss it in not this past week's Periscope, but the week before. I really talk about automation and the havoc that that's causing on the employment market. I really actually, it's funny, that was a really controversial Periscope. I actually think it was one of my best. So if you haven't heard it, I suggest listening to it. And then, of course, the market. That's the seventh Fed key. They have basically, in their statement, said that they look at two indexes. They talk about the S&P, which I'll get into later, and the HYG, which I'll get into later now when I talk about the 7 market keys. But let's start out on VIX. I created a VIX key. I think that this helps clear up a lot of confusion. I think there's a lot of mysticism around the VIX and what it means. It's basically just how expensive people are willing to pay for protection, like how likely they think the flood is or what have you. And I broke that down into a key here. If you want to pause and take a look at this and then come back to it, I encourage you to do so. Anyway, we're up in the purely directional options area here. You can see I had talked about the market having been in a period of low volatility. You did have some spikes, but they were all kind of measured and controlled. And we've been potentially, you can see we're making some higher lows and some higher highs here. If you kind of X out this spike, you can't really X out the spike, but for the purposes of this video, let's just say that hadn't happened. You were starting to make higher lows and higher highs, and now obviously that trend has snapped, and you've made a lower high and now a lower low, which is good for the bull case. The one piece of caution I would have here is that this low here, I think, will hold for a little bit to 1280-ish area, because this was the retrenchment low after the kind of the flash crash. So we're getting there could be a little bit more move down, but I do expect there to be a bounce back at least to the backside of the trend line in this breakdown here in the 16-ish area. So that's kind of, we're getting into the kind of the later innings. I mean, technically we snapped the trend line here so we could fill up the triangle all the way down here, maybe to the 11s. Very, very possible, but it gets harder and harder to play for that risk reward wise, kind of when you have, I like to play, for example, when there's 3-to-1 odds of my trade being correct. 2-to-1 is maybe the bare minimum. But when you start getting down into this area, you're starting to play 1-for-1, meaning you're really playing for the last, couple of ticks. And I get a little cautious. We're way bombed out here on the stochastics. We've been down here for a while. I would expect there to be some type of a bump in volatility in the next few sessions, maybe in the next week or two. I'm going to discuss that in a minute. The two scenarios I see likely playing out for the end of the quarter. And I will circle around to that in a minute. Let me just get through the rest of these keys. The UUP is the dollar. This I've discussed being potentially the biggest headwind for the market. And what's good is it's starting to make a series of lower highs and lower lows. The one little risk caveat is that we are starting to get to the bottom end of this consolidation, and any moves below 24.47 have been unsustainable. So we'll have to see. We're stopping a little bit ahead of there. We are below this sort of regression line, which is good. We are checking back to it, but as long as we're below there, I guess it's kind of better than not. But we are getting kind of close to the low end of range. We've come down quite a bit. I'd expect there to be some type of a bounce, maybe right to the meat of this distribution here, like the 2487-ish area. Let's see, what were these lows? 2489, 2489. Yeah, we'll just say that 2487 to 2489. That could be a potential bounce. we'll have to see how that plays out. Obviously, the lower the dollar goes, the better it is for companies that do business overseas. That had been a headwind for Facebook for a while. It doesn't surprise me that Facebook has been doing rather well. It's actually the best performing of the Fang stocks. We'll get to that in a little while. The bonds. I can't emphasize how important the bonds are. You can see we've used up a lot of the kind of consolidation downtrend move here, and this is really nothing. I mean, in the big scheme of things, look at where the 2009 crash. That's weird that that's showing higher. I guess maybe it was a little bit. I think I have to go back into the Wayback Machine for a little bit. I had been using that as the peak, but clearly we're the 124.23s. For now, I'll come back to that in a later video, but this is basically the area where we topped out the last time, 124.26. I have this written in here. This might be 2011, actually. Yeah, I think, let me just go back. I know that's right. Yeah, that's, let's see, 15 years, weekly. Yeah, see, I was right. And yes, this was getting into 2011-12. All right, so the 2009 crash peak was 123.15. I was on a shorter duration chart. And you can see we're well above there. So we've used a lot of this pullback time here. We basically come right into this sort of support, this old sort of resistance, now support area, and we're bouncing a bit. We're above the 50 MA. So I think a lot of this is basically the bond market has sniffed out that the Fed is just sort of blowing hot air and being a little bit, it's just tough talk, so to speak, with their potential for rate hikes. So we'll have to see if this continues to rise. It wouldn't really surprise me to see a bond rally now that we know that the rate hikes are pushed out a bit. Just keep an eye on this area, this 126.37 to 127.29. That's a very key area. You can see here this 127.21 and this 127.37. If these lows were to snap here, I think it would snap hard and we would get a retest here in the 123 area. But as long as this band here holds, the risk could be potentially to the upside here. So just keep an eye on those levels. The big concern for a while here, and you can see we basically got to the 61.8 from the 2009 crash low. We stopped just ahead of time and we've bounced back up. We're getting close to the 38.2, so there might be a little bit of resistance coming into here. You can see this was also really where this bigger breakdown took place. But the Fed talked about the differential between more high yield bonds and the risk-free rate, which is the TLT, and I think that this kind of spooked them quite a bit. It's healthy that a lot of this is coming back. It sort of takes a little bit of the recessionary tide off the table, but it really is in essence just kind of a check back to more normalized levels. So keep an eye if you're curious to know how things are going with the Fed. Keep an eye on the S&P, and they've told us now the HYG. Another really key barometer for global growth and the health of the economy has been oil. I know a lot of economists and market, the old guard in the market have not really understood how this relationship works, but we were really early on that, and you can see this was the 2009 crash low consolidation area, 33.20 to 37, and we kind of blew through there. Got down to 26s, which was sort of the old support from like the later 90s and 80s, the old resistance, and I guess it became support. We rallied back up. I was expecting close to a 200 MA test. We stopped just shy of there. I'm a little cautious that we will get some type of a pullback in oil, but look where this distribution really starts picking up and where this breakdown really started occurring from, the 43s sort of to the 45s. So there could be a little bit more gas in the tank. This is also sort of a distribution area. You can see that green line is in there at the 45.66. The backside of the old up channel uptrend here is up in the 48s. I do think we're going to see 50 or so in oil eventually, but it wouldn't surprise me to see some type of a pullback as you come up into the 44s and 43s to 45s. I'd start be looking to book some profits and wait for a bit of a pullback to kind of reload The way I've been talking about playing this has been through Exxon and Chevron. You can see where they're back up to. This was sort of a really important reference low. We had a little bit of time here below it, a little bit of time here below it, but you can see once we definitively failed and lost it, that's sort of when, the proverbial shit hit the fan. I was looking for a little bit more of an elegant way to say it, but sometimes the rougher words are the better ones. And the consolidated had a bit of a look above, failed below, and now we have a higher low. I like this consolidation. Anything above 83.01 keeps the dream of all time, of getting higher in play. Anything below there to me gets a little bit iffy, possibly down to the 50 MA. You can see that the 200 MA here was a lot of support. Once it lost it, couldn't quite even get back up to it here, but it sort of here became a little bit of resistance again. So to me, this like 50, 100, and 200 MA confluence here and the 78, 79s is the new sort of low. You can see the 50 MA here was resistance. I think it should support now. So if we were to come back down into that 50 MA, I think it's a good right or right out area. I do like pullbacks still in Exxon. I don't like chasing, but I do like the pullbacks. Chevron also, look where we are coming back up into the real breakdown area. So there's probably a little bit more up in Chevron before you start getting into this reference supply where people are going to be excited to get their money back. Again, same story. We did break the downtrend, which is good. But I would like to buy more back on, trend touches, pullbacks. Not really chasing the up after all of this, up move has happened already. I've been long. I'm looking now, I've been trimming profits in these oil stocks for a while here. Some other commodities. I know a lot of people are curious about what's going on with gold. We broke this downtrend line. You can see I now have it in green as a kind of a regression line. But I believe that buying a retest of the the backside of this old downtrend, like if we were to pull back, particularly if it coincided with a 50-day moving average and maybe some of these old reference lows, would be buyable for a right or right out type of a trade. You can see, look where this would come to. It's sort of the end of this distribution. So I believe that there should be some support there now in like the 113s, 114s. Maybe even the 112s to 13s, but I really think that area, wherever that confluence is at the time when this gets down there, would be buyable. Yeah, there's more room, plenty more room to the upside, and I do believe that gold is likely bottomed and is now a BTD situation, but again, it's moved a lot. I prefer buying dips than chasing, and gold always gives them. Freeport getting close to the end of a distribution range here. I said to start booking some profits between, I think I said $11.30 and $12. I didn't just come to that area out of nowhere. You can see where this consolidation was here. And then where the breakdown kind of really took place toward the end here. So it's good that we're above the 200 MA. I'm again, this is another one I think is a buy the dip. But as we move closer and closer toward these reference highs and the end of this distribution, I want to be booking some profits. Longer term, yeah, I think it's possible to get up to 17s, but I don't know that we're not going to have a 50 MA retest before that happens. So again, a bullish longer term, I guess, but shorter term, a little bit more cautious. FXI, that's China. Always got to have your China. We're getting close here, look, to the bulk of this volume distribution. So yeah, there could be some more room up. I mean, maybe we see 35s and 36s again, but up here, it's probably a good idea to start looking at books and profits as some of these passed by the dippers here are made whole. I would think that the 34s on up is probably a good area. You can see that's really where it started. That's where these reference hammers are. So 34s to 35s, I'd be looking to kind of start booking some profits. The BABA, that's another one. Obviously, this had a bullish consolidation, but what it really was getting back to all of this area. People were made whole. Unfortunately, it sold off. We did make a higher low, and the pattern looks good. You can see the consolidation, and this one did break higher, but look like where you're coming into. This is where all the dead bodies were from these people, this distribution, and then this distribution. So as you start coming up into this area and trying to fill this gap, I'm thinking you probably could, for at least for a day trade, somewhere between the 77s and these 81s, probably do a right or right out short for at least a pullback. I think that you could probably play by the dips with this, but I'm sort of think it's getting a little bit longer. I mean, yeah, I think short term we're going higher, but a bit more medium term, I think there'll be a pullback. You can see that there have been plenty of times to buy it, and we are getting a little overbought here in the stochastics. The IBB, that has been grim death. We all know that they are under a ton of possible new regulations. You have a regression line in here that is decidedly down. This was a head and shoulders top, a real major breakdown, a failed checkback. Again, a potential trend break that kind of set up these inverse head and shoulders. One kind of failed, it set up again, and then it really fell apart. Below the flash crash lows, once I would say anything below these lows here, to me is vulnerable. You had a bit of a check back, and now it's failed. So far, these lows are holding, and you have a bit of a bounce. And you have these reference lows. I would probably be interested in buying it for a right or right out trade somewhere around these like 207s to 212s. I'd be probably interested in selling puts actually at that level. My thinking here is just the technicals are begetting selling. A lot of people don't really know a lot about biotech, so what do? They buy the IBB. When they sell the IBB, the stocks go down because of the rebalancing in the ETF, and then they rebalance in the ETF, further suppresses the price in stocks, causing more selling in the ETF, causing more selling in the stocks, causing more selling in the ETF, and then you get this kind of vicious reinforcing cycle to the downside. If you're long, I would say 241.85 has got to be your stop. Anywhere below this hammer to me probably is going to get a breakdown in range and another leg down. So I think it's kind of a right or right out long over 250.45 and a GTFO or short below 241.85. That's the way I'm playing it. With regard to IBB, I think what's really been weighing on the psyche of people is this dumpster fire in Valiant. We all know about Bill Ackman. We all know about, a lot of companies are in this, and a lot of the same names that got burned in that Sun Edison. Let me show you what Sun looks like. Look familiar? This is sort of how this ended, and it ended in single digits. Yes, there were some very vicious bounces here, and I actually have posted on Twitter that I think after that this is off of everyone's books for the end of the first quarter, there will be one of these type of rallies. It's bad, though, that you're below the 100% retracement point, which is 32. I mean, this thing was a $263 stock, and it's now kissing, 26s. So, yeah, I do think that there is going to be, like I said, once this flushes out and everyone's out for the end of the quarter, there will be an opportunity to play for a bounce, but this could become the next single-digit wonder. This is burying funds, so just keep that in mind. One I actually am starting to warm up to is this Alkermes. This got nailed on them not having some type of an approval. I discussed this area being a buy. We didn't quite get there, but what we did get, and let me get us into more modern times. Why am I starting to warm up to this? You had a gap fill down in the 25s. We didn't quite get there. I was looking for that test, but there is something I'm seeing, and I'll show you here. Take a look at this. You have a low with a hammer, another low, and then the next day, a hot, like basically you held the body and you closed up by the top. So this technically should be a secure low here. So I think you can play right or right out long versus 28.80 stop. That's this day's hammer and this day's body. I think below there would get a little bit more iffy. If you have a little bit more brass in the tank, you could use 28.25, which was this low as a stop. But you basically triggered a long trade here once you got above 30.32. We closed just below there, 30.20, but I would think that this is probably going to try and have a bit of a move up. So I gave the levels there for that setup. Anything below there, it's GTFO or maybe even short, but I think it's worth at least a bit of a long test. Let's get into the real meat of the discussion, which is the S&P. We broke the downtrend, which I am now using as a regression line. That is just kind of how I roll. And you can see where we're getting into. This is the meat of this distribution and the gap fill here. This was the gap fill. Notice anytime that we've lost 204.12, look here, collapse. Here we had a bit of a collapse, but we were able to recover quickly. Here had a few days, but the last time here, this was really where it got ugly. And then when you lost the 99.83s, they tried, but it really failed. So look what happened here. You had a bit of a move back to the downtrend, and there was a bit of responsive selling. This was the ECB day. You had a look below and fail. I discussed that this probably wasn't as bearish as people thought. We powered through a few days of consolidation, the Fed day, some follow through, and then a little bit of consolidation. Look where we are getting back into, the gap fill and the breakdown. So my read on this is as follows. There could be a little bit more up. I did a measured move. If you calculate from this low, the pullback low, to this high, that's $24.73. If you were to project that off of this low, that would take you up to 205.82. So we're getting rather close. The next really big reference area here is this 206.76. You can see that, you can't really see it in this chart, but you could see there were some supports here. When that lost here, that was not good. I also kind of see this as where the meat of the sort of upper distribution picks up. So yes, it's good that we filled this gap. It's good that we're above 204.12. Now it's sort of, you got to hold it. And I do see that there is potential for a little bit more up move. As I just drawed out, I drew out, I said the measured move, and then, where kind of the upper part of this resistance becomes. But I think that the probability of a pullback is starting to mount, particularly after this many days up. It just seems likely that the market is going to find some, I guess, people who bought up here, this distribution, they're looking to get their money back. So I would expect a bit of a pullback. What would be healthy in terms of a pullback? If you look at what the measured move is being priced in by options next week, it's to 206.88 on the upside. That's a smidgen above this area, this reference area. And a move down would be to, the approximate move is about $2.50. It's a little under that. Would be to 201.88, which is really 201.90, this reference low. And this consolidation, I think that the market would be healthy if it can hold the 201.90. Anything below there to me starts putting the 199s, 200s in play, and then if you lose that, the 197.86s, and if that is lost, then I think we're in for a really nasty sell-off. But as long as you could kind of have gentle pullbacks and hold this area, you could see this is sort of the meat of this distribution. I think that the market could potentially push higher. I know nobody is talking about this. I've been saying this for weeks, that we could see potentially a blow-off to all-time highs. Really wouldn't surprise me, but I do think it would be healthier and more sustainable if the market kind of just chopped and did it in a bit of a begrudging fashion rather than spiky action, particularly after all this. This consolidation did work off a lot of excess. So did this one a bit, but we are getting a little extended here. We're not as extended as we had been at prior points. The 20 is here. You can see the 50 is now bent upwards. You have a 200 MA that we are now through. That should now support, and look where that is, roughly around that 201.90. So that, to me, as long as we're above 201.90, I think the market is kind of, quote unquote, like I said, healthy. But I am looking to be a bit of a seller into this area. I discussed the VIX, how low it is. I think that the best way to play it is with longer dated put spreads that you could turn into ratios once the move starts. So I gave the example, if you bought the 205s and sold, let's say, 195s down here, and then as this comes down, you could sell, 187s or 190s or whatever, depending on when you come down, to eat up some of that premium that you outlaid for the buy. So it could become a fly or a spread or what have you. There's a lot. There's plenty of ways to. I hate the term, but skin a cat. So, like I said, possibly a little bit more up more. But remember when I talked about the probabilities, the 3-to-1, 2-to-1, 1-to-1. You're getting closer to the 1-to-1 up here in my view. Particularly any spike moves, I would think are particularly a gap fashion probably would be a good opportunity to lighten up or try right or right out shorts into. Let me talk about some of the financials while we're here, because this is really what's going to have to start participating for this to kind of catch fire. You have a bit of an inverse head and shoulders set up here with a cup and handle. And I like that we're closing above the 26.16 neckline. And as long as this 50-day moving average and 20 MA, you can see the 20 is crossing through the 50, there could be a move a little bit higher. I actually tried nibbling this for a right or right out, but won't be in there long if this setup fails. So right or right out. Goldman Sachs, I had talked about being in a longer-term head and shoulders pattern. Let me show you that. 2 years daily, you can see the left shoulder, the head, the right shoulder, the neckline, break, and now we could have potentially a check back. So longer picture, bigger picture, bearish. Shorter term picture, a little bit more bullish now that the 50 MA, which was resistance here and here, has been taken with authority on Friday. If you lose the Friday bar, GTFO, I'm not in this either. I'm not in this, by the way. I'm actually more looking to short the retest of the neckline or the downtrend. But to me, this is looking, you have some kind of some reference lows here, held, and you have a bit of a kicker pattern. So that, to me, short-term bullish, longer-term bearish. Same thing with JP Morgan. We know about the diamond bottom here, this island reversal. Held to 50 and now kind of closing above this range. Getting into some resistance, though, some past area, but there could be some more bounce to the, ounce to the bounce, so to speak, to this where this 200 MA roughly had been support. Maybe that'll become some resistance. IWM. So I talked about there being some potentially more upside in the market. Maybe it is when the IWM fills the gap and gets to the the downtrend to 200 MA. You can see this upper distribution here was in the 114s. What was the exact number? 114.29. So if we can get up to close to there, and you can see that that's basically the 200 MA, particularly in a spiky fashion, that to me would be a great right or right out short. You have all of this past supply up here. You'd have the gap fill and then some to the downtrend line. You have a 61.8 just above, which is the meat of the distribution. So anywhere up in this area I think is a great right or right out short. I would be doing that in size right or right out, particularly after this action. So maybe it's going to take a little bit more time for IWM, and that'll kind of coincide with when SPY tops out. Still showing a lot of relative weakness, though, in IWM. Qs, right up to the 61.8. This could also augur for some resistance. You have a big confluence here of the the 200 and the 100-day moving average and the 61.8 Fibonacci retracement of the move. However, we'll have to see. Like I said, this is now it's like we hit it. The pullbacks have been rather muted. It seems like, a bit of a consolidation that might want to power higher to the end of the distribution and fill up this gap here. So, we're getting some mixed signals that we are into some resistance, but the resistance isn't acting so terribly yet so far. It just has been consolidating. So I would use these 2-day lows here, these pullback lows. Anything below there to me could get a little bit iffy for a little bit more of a pullback, but if you take these 3-day highs, I think that the path of least resistance there will be higher. Apple, getting into the 100 MA, getting into the prior breakdown here in the 106s, 107s. There is some room as long as the 103s hold to see the 109s, maybe even the downtrend line into the 111s. You can see that was a key pivot here. It was also the flash crash low. Could see this particular flash crash low. So I believe that this area will be important. You can see the upper distribution here gets really going between the 109 and 111. Would not shock me to see that type of a move. Yeah. I had talked about in last weekend's video, it was the first time in a long time that I was constructive in Apple. That has worked out well. I do see potentially a little bit more upside with the market if it cooperates, but I would be more inclined now to be looking to sell into Apple strength than now to first be loading up into it. I would be more of an interested buyer if we did have some type of a pullback into some reference levels, like the 100 or the 103 for some type of a right or right out type of a trade. Let's get into Fang, what everyone is curious about. I discussed at the beginning of the year that the only one of these that I really thought had potentially to remain strong was Facebook for a various number of reasons. One was that I thought they were taking market share from Google, that they would be monetizing Instagram more, and that really has played out. I had some opportunistic put sales here that I took off up here, reloaded here, and then I'm still into them, although I'm looking, if we start losing the 110.65 to 109.29, I would probably be looking to take that off. I am looking to also take it off into some strength. They've been worn down a bit, but anything above 110.65, that was this consolidation range high, and you can see we've been holding it. We had a bit of a look below and fail. Anything above there to me keeps all-time highs in play, and then some. Careful, there's a regression. I've talked about anything on the wrong side of this, progression. It's an up move. Regression means down, like this is the regression. Up is progression. Gilead has something similar, but we're not going to cover that here. Anything above there to me, at or above, gets unsustainable, so I would be a little bit careful and looking to book if we get up to there. 110.65, that's the key number here. Short term. Amazon not looking strong at all, looking very rounded top-ish, lower highs, lower lows, struggling. You have basically some reference support here at the 547.90, here 546.09. If these lows are to get taken out, there's probably some room to the downside. If they can hold, you probably have a little bit more room up to the top of this distribution. Seasonally, it's not the best time for Amazon. Usually this does better toward the end of the summer, getting into like the holiday season. So you can see when this really took off here in is this January, December, November? Yeah, look, here November is sort of where it, November, December. This area was sort of where we bottomed out, and then it rallied up. I'm a little bit cautious here. You can see there have been, let me just show you. Oh boy. Past periods here of, decline. This, I don't know that this is for sure one of them, but if we were to come back close to the 400s, I would be very interested in buying. You can see there's a gap fill here, this old reference high, so somewhere in that area to me would be an amazing setup. It may even overshoot and get the primary trend. That to me would be a screamer for a right or right out type of a buy, particularly if it took back all of this kind of bullish move. Netflix. So this is a bit of a muddy picture. I've been looking for it to kind of fill in this gap to the breakout to the 70-ish area. We were getting close, but we looked below that flash crash. Now we're kind of trying to work our way back higher. I'll be curious to see how this behaves itself. If we can get through this 103.88 to 105, 106 area. 105 to 103.88 was a very important support region here, and it failed. I would think that there are probably going to be, I would think some sellers here once you took out, look at this bullish candle here. Once you lost that low, in my opinion, trouble. That was 104.96, so roughly 105. You have a 200 MA up here. 100 MA, a 50% fib. I would be looking to start booking this a bit up here if I were long. It's good that we're through the downtrend, but I don't know. I would be more of a interested seller as this rallies. Oops. Google. I've talked about how I thought this pattern was bullish. It has been. Anything above, let me zoom in a little bit more. 752.05, that was this gap high of day. We're above there. We basically held. Anything above there to me is, and the fact that you're over the 50 is good. But for me, I always find that the best places to buy this are sort of either at the channel lows or to short near the channel highs. I don't really like to play the in between. I'm sort of in all or nothing with Google, meaning I like it to short it at the channel highs or to sell my long out at the channel high or to buy the channel low. Simple as that. That is how I will always continue to play Google. Price line. This has been more bullish than I thought it would be. It had a pretty strong rally off the lows, gapped, and basically rallied, kind of came back, and now is higher. I sort of thought it was going to be one of these where it rallied up, gapped, and then crapped and filled in to retest the low, but it is coming up. I know a lot of people think we're going to fill the gap. I think that it's probably more likely that you test this area, which was this reference high, the 378.96, and then have some sort of a pullback because you'll have a lot of people in there chasing at the wrong time, thinking the gap is just going to fill instantly. Very possible it does, but I just have a bit of a feeling that this high, this sort of lower high, I'm sort of equal high. This area to me, I think, is going to be a little bit iffy. I would be looking to take profits or even try a right or right out short right into there. And when I say right or right out, I mean right or right out. Chipotle, I discussed this, that I thought this was going to be this past support area would be resistance. It sure was. We know that they came out with that they have having worse. This was the day it actually wound up being people bought it, and then afterward it got sold. But we know that they came out with worse than expected sales. We know they've been having problems. I'd probably be interested in this somewhere around the 442-ish area. I'm curious, like 442, 435, these reference lows. I don't know if it's going to get a retest of the old low, the trend. We'll have to see, but it wouldn't surprise me if this area caught some support. So if you're short, I'd be looking to book some profits here, or if you want to try some right or right out longs, I think that would be a good area. If you still think short and you want to get long lower, I like put ratios, like buying in here and selling 2 times out here near these reference lows. I think that would work out well as long as it's near dated. Some dumpster diving I've been playing around in is this AMBA. Also, I talked about that ALKS. I did some valuation on this, and I figured that 12 times earnings is 31, basically. Micron is trading at 5, and Intel is trading, I think, at 17. So I figured AMBA has more growth than either of those, in my opinion, right here. So it should probably trade at a premium multiple, but worst case would be 31s. It's a lot of reference support here. I have a little bit of long in here. I think I have some short puts. I forget what the exact information is. If you're really curious, you could ask me. If you want to try it with shares, anything above 36.49 to me is a long. The low here was 36.66, so 36.66 to 36.49. Anything below there is a stop out at this point because, look, you have the retest of the backside of the old uptrend line. Again, retest, a look above and basically a few days above and fail, and now you're kind of just hovering under there. It just seems like some consolidation to me. I would guess that there's going to be a rally in here. If it breaks down, though, out or short below here, frankly. Just that's how it is. So I think we could wrap up there. If you're not following me on Twitter, my handle is @JustinPulitzer. My YouTube channel, you're on it here. Be sure to click the subscribe button. You can get notifications when I post new weekend reviews, Periscope rebroadcasts, or special edition videos. If you liked the video, please leave some comments. If you didn't like the video, please leave some comments. Just be respectful. I like the feedback. It helps me make the video better. And please hit the thumbs up button if you liked it. My ego can use a little stroking once in a while, too. Anyway, let's have a good week, and cheers.